All right, wonderful. Welcome to Growth and Inspire, where we examine complex topics that make us feel inspired and grow. I'm your host, Bonnie Yam, and we will be posting frequently on topics to help you run your business better. It can involve complex topics, including new regulations, taxes, planning for business growth, or running your business more efficiently. Whether you are CEO, CFO, or any C-suite members, this podcast is for you. We hope to bring you insights and discussion points to drill down on the complexity and make it simple. Join us on this journey as we will have a lot of interesting guests, such as business evaluators, insurance experts, bookkeeping experts. And don't forget to subscribe and leave us a review if you enjoy what you hear. Now, let us get started on today's episode. Today, our topic is going to be on Secure Act 2.0. It is the new provision to help Americans save more. The implementation is very complex. A lot of people don't even know where to get started. So we are very glad to have our guest speaker today, Adam Hunt from EasyTPA. He's the owner and founder, and to assist us in navigating through this complex regulation. So hello, Adam. So happy to have you here on our podcast. Before we start, can you tell me a little bit about yourself and your company?
Yeah, absolutely. Bonnie, thank you for the time and really appreciate being here with you today. So EasyTPA, we are a boutique third-party administrator. We do consulting and practice management work on corporate and not-for-profit retirement plans, including pensions, 401ks, 403bs. I founded the business right at the start of COVID in 2020. And today we administer approximately 600 client plans. We have a staff of 6. So I'm very pleased that we've had the success over the last several years, and it's a pleasure to be with you today.
Wonderful. Yeah, Adam is very knowledgeable, and I've been speaking to him quite a lot about all these new rules and regulations. And so would you like to, just before we get started, just tell us a little bit about Secure Act 2.0 before we jump in for the more complex discussion?
Yeah, absolutely. So we should probably go back and talk about Secure Act 1.0. So 1.0 came into existence back in 2021. This was right in conjunction with the CARES Act, which was built around the relief for COVID. Secure Act 1.0 set in motion what is Secure Act 2.0, but 1.0 really focused on fixing certain administrative challenges that we had in terms of complying with IRS rules. Most notably is that it changed a little bit of the definition of what trustee and fiduciary are, putting a little bit more onus on the owners of the businesses. 2.0, which is that continuation, change the dynamics by which the participants are now going to experience the retirement plan. So, for example, one of the big changes was if you start a new plan, you now have to have automatic enrollment. Previously, if you started the plan prior to 2023, people had to opt into the plan. Now it's an opt-out. So the idea behind Secure Act 2.0 was to help people be able to prepare more for retirement, to encourage retirement savings amongst employees in the United States. Only 40% of employers offer some sort of retirement plan to their employees today. So there's a very large swath of the economy that doesn't offer that. And it also changed some of the accessibility rules. How can I get access to my money? What are the needs for that? Because one of the big pieces for people is like, look, I'm saving for retirement, but sometimes emergencies occur. So it did make some changes to those rules, amongst others, that I'm sure we'll talk about today.
Yeah, very good. Yeah. But then, anytime we talk about rules and regulations, people are scared because, oh my God, so what do I do? How do I get started? Who should I talk to? And, before I sign this little piece of paper, am I all good? So, I think there are quite a few parties involved, besides the plan owner, okay, always the fiduciary. And then sometimes they only have the record keeper, so they don't have the TPA, which help them with the plan design and so forth. And then they have the HR. HR is not just doing 401k, very busy person. So, there's a lot of people, and the plan advisor too. And depending on whether you work direct or you work the TPA, I mean, and who is involved, who goes in and out and all that. And you have this payroll person, you know, and maybe another outside party. There are like 3 or 4 parties involved, and it's very confusing. So maybe
Correct.
let's just start with a record keeper, you know, because like they're big record keepers like Fidelity and smaller
Mhm.
ones too. And then they all find this pretty confusing because there's lots of laws, lots of regulations, at least, you know, 50, 60, I don't know how many, just quite a lot. And there's some mandatory, I know, and some optional. So what are mandatory, what are optional? And then there are timeline, deadlines for every single component, and who's going to initiate, who's going to sign off, who's going to approve, and all the paperwork. It's very complex. So maybe from the record keeper, I mean, like a record keeper was basically the company that holds the asset, the retirement
Mhm.
assets, and they are basically backing people because any money that goes in and out, you know, they're responsible. And then because of that, you know, they have to have a lot of technology changes, updates to make sure that it's in compliance with Secure Act 2.0. So maybe I think what would be good is that let's start from, you know, your experience with Record Keeper. How are you working with them to make sure that the Secure Act 2.0 is being run and implemented correctly?
Yeah, sure. So just to touch base on kind of the way that these are structured, right, as you mentioned, Bonnie. So within all retirement plans, you have a record keeper, which is really doing the trust and custody work. They're maintaining the participant level accounts, providing the call centers, the statements, those kinds of things. You can then have the administration, which is what we focus on, either done directly by them, i.e., like a Fidelity, or you can have, which we call a bundled environment, or you can have it unbundled, where we're taking care of that administrative function, right? In conjunction with the record keeper. And so, you know, this would be like if you had it at Vanguard, for example, they unbundle stuff, right? Um, so across the spectrum, though, regardless of whether it's bundled or unbundled, everyone's really operating on a kind of a level playing field. And one of the challenges that we have right now in the marketplace is that Congress passed Secure Act 2.0, but they left all the very specific provisions on how to actually do these things to the Department of Labor. And the DOL is slow. They don't move very quickly. And you know, the problem is that it takes time, whether you're on the record keeping side or on our side or the payroll side, right, to update your systems to accommodate. They can't say, hey, it's going to be in effect tomorrow. It's like that takes 90 to 120 days minimum.
Money too.
So, for example, one of the things that came out through Secure Act 2.0 is now employer contributions can be Roth, right? So
Yeah.
previously you had Roth 401k, right? So your money goes in tax today, but the earnings come out tax free, right?
Yeah.
Which is a great deal. The employer contribution can now do that. You can put in money on behalf of your employees, or if you're the business owner and you want to put your own money in and say, I want to pay taxes today, but I want to go tax free, you can do so. The regs on how to actually do that only came out several months ago. The big question remaining is, okay, well, how on the payroll side does that show up on a W-2, right? Or what if the business owner is doesn't take a W-2? Let's say they're a sole proprietor and they just get a net Schedule C. How does that show up on the tax forms? And we don't have answers to that yet. So there's a lot of good things in Secure Act 2.0, like the Roth employer is a huge benefit. But the record keepers and the payroll they weren't ready for it. So now they're prepping for it to have it ready by the end of the year kind of thing. So that's just one good example of how with these rules it comes in. Where as a TPA, what we try to do with our clients is be a little bit ahead of that, right? And say, okay, here's what your expectations should be. Here's what you need to have communicated to you. Here's what you need to consider. The one big piece with all the Secure Act 2.0 legislation, I shouldn't say all, but a vast majority of the regs in it, is they're what we call protected benefits, right? And what that means is that once you say yes to that optional feature, it is permanent in your plan forever. So if your business stays in existence for 30 years, you have to operate that under 30 years. So there are certain ones that we're saying, yes, this makes sense. You should 100% do it. And then there's other ones we're saying, let's see how the regs come out. Maybe Congress will change some rules around how those operate. But the Roth 401k employer is a no-brainer. That's a yes every time.
May I ask, like, can they change their mind? I implement the Roth and I find it too complicated, too complex to implement, so I want to Change my mind
Yes.
now.
So the Roth employer is not considered a protected benefit. It's not one of those protected benefits, interestingly enough. So you can offer it, and then you can say, "Hey, I'm no longer going to offer it." However, you couldn't undo it. So if you put in $1,000 into
Oh, I
that
see. I see. What you put
account,
in, of course, you
it's
cannot.
always there.
Yes.
You just can say, "Hey, no new money comes in
Yeah. Okay. I get
on that."
it. Yeah.
But yeah, there are other ones that administratively sound, at least on paper, sound great. There's one which we call the Emergency Savings Act, right? So you can put money in and then you can take it out at any time for any reason. And the challenge is that the systems aren't built to manage that well. So all the liability and the responsibility falls back on the employer. But more importantly, is if they decide, hey, we decided we didn't like this anymore, doesn't matter. It's there. And so a lot of what the Secure Act 2.0 around, Bonnie, is really working with people like yourself and myself to kind of go through that checklist and say, here's what you want to consider. Here are the things that actually are valuable. Here are the things that you don't want to do today. And here are the things that you have to do. Like there's some things that you just mandated to do regardless. Like I said, there's a lot of really great things in Secure Act 2.0. But like all things, the idea, the intent is there, but the execution just lacks. And so there'll be clarification from the IRS, and they have panels and people come back like myself and say, look, this is not operationally feasible. Fidelity comes back and says, this is a great idea, but we can't do it. Here's what we would like to see. And then rules change around that.
So what I like to say is that Adam actually has a list of checklists. So you can go, one by one, go down the list of what I like, what I don't like, what I should be implementing, what I don't need to implement. So at least, get yourself familiarized with what's out there, because there's quite a lot. And what you feel comfortable too, because I'm not a big company, I'm a very small company, I don't have that extra pair of hands to do this and that. It's too complicated. Somebody call me, I mean, I don't want to get into trouble. So maybe it's not something for me, maybe not yet. So you need to understand the level of complexity, how it pertains to your company itself, okay? And then who will be involved? Some people work directly with the record keeper. Some people has a TPA would be working with Adam. So he'd be like, helping you manage the workflow and assist you in getting it done between the payroll company, between the record keeper. So there's got to be like still one person. I don't know who, depending on the setup of the company. But then there will be one person that, at least like one person you go to make sure that it's getting done. So maybe it's Adam, maybe it's the HR, maybe it's somebody from the record keeper, but you need to identify. I think that's probably the owner or the sponsor responsibility, at least to know they have a go-to person. Work it out, okay? This is gonna be like, because everybody's a little confused. So pull them together and figure out a work schedule to make sure that when you're implementing it, okay, all right, so all right, timeline is coming up, deadline. I think it's my call. If I don't call you, it's still your responsibility. Please get it done. So have like an overview of what's involved, and have a plan if you have more than one person involved. Who's going to get done with what? Okay, and so you don't get like terrorized at the end of the year. What I only have like 1 month. I got to do so much. So so actually, just like any tax rules, any new regulations, always going to be very complex. But once you get the handle of it, it's not quite so bad. It's just absorbing new information, new complexity, and having a good setup so you implement it well, right?
Correct. 100%. You need everything with the IRS and the DOL and all retirement plans is really about the paper trail and creating the right compliance structure around it. And we do see a lot of clients that come to us that just never had those proper procedures in place. And so if and when the IRS or DOL comes knocking, which isn't very frequently, let's be very honest, but when they do, it's a scary letter, right? You have only several weeks to comply, and they're looking for easy ways to say, okay, well, this wasn't in compliance, and we're going to assess a penalty, right? So documentation and process and procedure are really, really important.
Yeah.
And if you don't have that, that's where I think we can help.
Right. Wonderful. Yeah. I think that's why, sometimes if you don't have that extra pair of hands and your HR is too busy, it's probably good to have another third party that can help you, whoever that person is, identify it early on. So how about just dive in on some of the fun things? So can you tell us a little bit about some of the interesting Secure Act propositions that most plan sponsors should really say, very interesting. I think that's going to benefit my employees. Like, which are the ones? And then we can dive in
Yeah,
on that?
absolutely. So I think we touched on the Roth employer. I think that benefits every employee. I mean, ones that I think are easy to implement that and it is important to note that the way that the reg is written right now is that you operate as if. So you do want to have a checklist to say, yes, these are the ones that we're going to be implementing. These are the ones that we are not implementing, and then having something signed and dated saying, okay, great. I have documentation that said I was operating as if until such time as the final regs are done. Because until the final regs are completed and all the fine print is, we can't actually provide the amendments, the legal documents. So there's like this, the checklist and the operate as if is really important. So the employer Roth is one that's 100% you should absolutely consider. Other ones out there is there's an expanded definition of for hardship. So like qualified birth and adoption is another one that's been added. There's another one that if somebody has been diagnosed as terminally ill, right? Previously, you could not access your money, even though you were diagnosed as terminally ill, which almost is kind of wrong. So that's been righted, and so you can add that, right? Okay, if you're terminally ill, you 100% can get access to your money. There's no penalty, you just pay taxes. Those are two really, really good ones just off the top. There's another one for disasters. So previously, you had to wait for the Department of Labor or a federal agency, FEMA, to issue. This is a area that was, hit by a hurricane, and therefore we have to give you specific for that hurricane to get relief to get your money. That's not there anymore. Now it's just, hey, if this was deemed a federal emergency, boom, it's automatic, right? So those are all easier pieces to get to. Now, the two that I think kind of jump out that people at first blush would go, maybe I should do this. So the first one is the college matching, right? So if you have people that are working for you and they're like, look, I'm trying to pay off my college debt. I know that time is important. I need to be putting in money when I'm young, but I just can't afford to do both the student loan repayment and the 401k contribution. And that 401k contribution gets a match, right? So let's say, for example, if you put in $500, I give you $500. Just a very simplistic example. And let's just say your college payment had to be $500. What you can do is you can say, okay, look, we're going to add this feature. And if you're making your loan repayments for your student loan, we'll act as if you actually made that $500 contribution to the 401k, and we'll give you the equivalent match of what you should have gotten. It's a great idea. The problem with it, first off, is that it's very clunky to manage, right? So you have to be able to calculate it as the employer, because no payroll company is set up to know what a student loan repayment is for Bonnie or Adam. And then secondarily is we're still waiting on the disclosures is how do we like formulate that into, do we report this somewhere on the tax returns for the person? Do we not? So there's some confusion there, but it is a protected benefit. So once you add it, you can't remove it. You can't suspend it. It is permanent. And so the way that it's written right now is just, all the liability falls back on the employer to make sure this operates correctly. And that's not really fair to the employer. So there needs to be some sort of middle ground there.
We can wait a little bit.
Yeah, they can wait a little bit on that one. That's the first one. And then the second one is the emergency savings fund. So the emergency savings fund says, at first it was, you can take out $2,500 for any reason and you don't pay taxes.
No penalty too.
Nope. No penalty and no taxes. It was actually all done via Roth. So you had to do it as a Roth 401k contribution. So the first $2,500 you put in, or you get from the company, so you could do both. But you get up $2,500 labeled as employer, as emergency, right? The problem is you can only take the money out once every 3 years, and no record keeper is set up to track that. So that means all the responsibility falls on the employer. So if I took out $2,500 and I predicted zero, and then I put $2,500 back in, I can't do anything for 3 years. And if I take it again and there's a mistake, the employer is liable for the liability. Yeah. Both are silly rules. You should just be able to take it because you want it. Like, I put the money in, I already paid you taxes.
Why 3 years? I
take it every 3 years. Very silly. Very so the feedback there to the IRS was like, hey, that's not a great option. Like, why would we do this? Make it easier for people. Like, it should be, hey, I got 25. I want to take money out because I need it. The end.
And you put it back if it goes undone, and then
if I put it back, great. If I don't, like, whatever.
Yeah.
So those are ones that like just jump off the page as the two that we're really saying, like, look, great idea with the intent. the way that it's set up, it's not, you're going to be very difficult to administer unless you're a really large company. Like if you're, Pfizer or Johnson and Johnson, you have a team of HR,
Keep
like
them
you
just
could
doing
do
this.
that stuff. Correct. But if you're like our typical client, right? We service clients that have under 100 employees. That's our target
Yeah.
demographic. If maybe you have one person, it's not a company of an outside bookkeeper. You want to keep things as simple as you
Oh,
can
yeah, yeah, yeah.
and provide for the benefit as best as you can for your employees.
Yeah. So I'm hearing there's some like good things like the
Mhm.
emergency savings, like a lot of additional options where you take the money out without the penalty. And then you'd be able to more flexibility because a lot of people just need that $500. If they don't have the $500, they can't get their car repaired. I mean, it's just
Yeah.
like big thing for them. So they're more those. I think those are optional, but it's a preferred option that because it's a
Mhm.
benefit to your employees. So that's great. And I also know that they're changing the RMD rules, so they're moving it back. So if you have a lot more
Mhm.
pre-tax money, then you can put it there longer before you withdraw it and start paying taxes. So that's also
Mhm.
good. And then you talk about the Roth, which is also great because I mean a lot of people who want to do the Roth because they don't want to get bogged down by taxes, and we think that maybe taxes is going to go up in the future instead of going down.
Mhm.
So there's a great option. So, but then the implementation, anytime when you deal with taxes, there's the payroll provider involved, and then
Mhm.
TPA too, like you yourself, because you have to make sure that whatever is being contributed pre-tax, post-tax, two separate buckets, so we cannot
Has to go
commingle,
to its right
confuse.
places.
And then
Absolutely.
when you take money out, which bucket now? Very
Yep. It
confusing.
happens. People just commingle them. I didn't mean to. It
Yeah.
happens.
So it's
There's
another
a lot.
yeah. So it is confusing. It is good, I mean, it's benefit, but it's
Mhm.
somebody has to keep track of how the money goes in and out. And
100%.
same with what you comment on the student loan. I also hear that no verification is required, so they can just self-verify.
Self-verify on hardships now, self-verification. Yeah, there's the a lot of the stuff has been again, the designs were intent were like how to help people. I think some of it was let's put some responsibility back on the employer, and so there's some inconsistencies there,
I
but
mean, if
overall
nobody
it's good.
verification, no verification, you know what?
Yeah, I mean, look, there's lots of people that will go, I have a hardship. I'm, for whatever reason. And you're like, that's not really a qualifying reason. But yeah, that, I mean, that is a good thing, I think, in the near term, right? Is like, I don't have to say, Bonnie, tell me about your personal situation. Bonnie just says, I have a hardship. I'm taking my money. They self-certify. Then if the IRS was to audit them, they have to provide evidence. So what we do, because there is some still liability on the employers, we provide a checklist. Here's all the things that you can qualify for.
Yeah,
Here's the
yeah.
documentation that you would need should the IRS show up at your door and say, hey, we want to just verify that you actually had a hardship for that reason. We've yet to hear of any participant having
Issues.
gotten, we don't expect anything in the
Knock
near
on wood.
future, but the IRS
Not a lot
is
of
an
money,
interesting
so
creature.
I mean, but still, you guys like just be careful. Now I have another question for you because this is also confusing. Like now for the distribution, who authorized it? I thought sometimes like they said record keeper. Okay, so because everything's online now, type I'm gonna get
Mhm.
distribution for whatever. So the record keeper, or I also understand sometimes it go through the TPA. The TPA pre-authorized before they get sent over to the record keeper. So how does it work? Is it direct or through you?
It can be either. So it really is part of that conversation when we're establishing the relationship, right? But you can do it where it's all electronic. That's always our recommendation because there's
Of
a
course,
permanent
of course.
file that the
Yeah.
record keeper has to keep legally for 3 years. Um, and it's very hard to make a mistake when you're doing electronic,
Yeah, the electronics.
right? Unless you type in a wrong
Right?
ABA number or your account number, right? Those
Uh-huh.
kinds of
Yeah.
things.
Oh,
But yeah, normally the process is, Bonnie, like if you went on and said, I want to take a distribution for hardship, you go online, you put it in, it would come to us, we would review and say, okay, great, yeah, this is fine. And what we're really looking for is, okay, can you take it from these sources, right? Those things and go, yeah, this is all the correct amounts. And
mhm.
then we send it to the client via email. Like they'll get an alert from the record keeper saying, hey, Bonnie has a distribution pending. You'll get an email from our staff saying, hey, Bonnie requested it for a hardship. You just need to go online and approve.
Oh, so okay,
Um,
so there might be
and
some
that's it.
approval process, but
Yeah, but
sometimes they make it easy.
there's language in the online that basically says that you're self-certifying for a hardship. You can still do transactions via paper. That is going away, but it's still accommodated. We highly discourage that, only because the paper is easy to make a mistake on because those forms are not clear. Like they're very, someone else wrote them. I'm not sure who, but
Can you
didn't really think about, yeah. So, they check wrong boxes and wrong reasons, and, they don't sign the right spots, and it's just back and forth. But you can always do via paper, but the process would work the same. It comes in, we review, send it over to the client signs, and then gets submitted to the record keeper. But yeah, we really do recommend everything to be online, loans, distributions, all that stuff.
Going anyway.
You can do wire, you can do check, it's all like, it's almost as if you called the service center now. It's great.
I know. And then you get AI assisting now too.
Yes.
All right, I have another question because this can be confusing. So I understand the plan documents, all these changes doesn't have to consolidate. You basically have a deadline for all those changes, and it's not this year, it's next year. End of next year, is that correct? Can you talk
December 31st of 2025, you have to have your documents signed. So again, the way the checklists are written is there's certain things that started in 24. There's certain things that'll start in 25. There's certain things that started on 7/1/24. You'll just go through and document, hey, I'm doing it, these things. And like I said, with all of our clients, we kind of pre-selected for them, like, here's what we think is best way to do it. And then we go through and have a discussion just like this. And invariably 99 times out of 100, they'll follow it. Sometimes they're like, no, we really want that. And it's like, okay, as long as you understand the ramifications of saying yes to that today versus just waiting. But yeah, December 31st of 2025 is when they need to be executed. Now, it is important to note what happens if you don't sign it on December 31st, 2025.
Yeah, so what happened?
Okay. So the IRS will give you a really scary set of words. It's called an operational failure.
Oh, no.
Everything is an operational failure with retirement plans when you don't do things correctly. It doesn't matter what it is. That's just the terming they use. Almost all operational failures are now self-corrected. Versus going to the IRS and saying, oops, I made a boo-boo. So the self-correction program is you basically say, here's where I made the mistake. You identify it and go through. So if after December 31st of 2025, you don't sign, you sign it on January 3rd of 2026. During that 3-day period, you technically had an operational failure. You just have to be able to say, yes, we operated the plan as if, yes, we made sure there was no other outstanding amendments, and yes, we brought it all up to spec. The IRS could still theoretically come in and say, hey, you didn't do it untimely, and create some havoc, but they're not going to disqualify your plan. Unlike previously, they could. When your plan gets disqualified, which happens extremely rarely, like, to be very clear, it's a 50% excise penalty on the amount in the plan charged to the company. Not to the employees, to the company. So if you had $1 million and they said, we're disqualifying it, $500,000 penalty to the company.
So just close
but in 30 years of doing this, I've only seen one plan disqualified, and
but this doesn't scare them though. So,
yeah. So it doesn't happen, but you hear these words, operational failure, disqualification, and automatically it's goes through. I will say this with the IRS specifically is most of the mistakes that people make are common, and they know it. And the important part is when you have a mistake is just correct it, follow the procedures that they want, document, put it in a file for 3 years, and don't look back. And the number one way that the IRS does, investigations is actually participant complaints. Something like 99% is because an employee calls disgruntled, said, this happened. That's where, and there's like 40,000 instances last year, I think, something like that. Where the IRS investigated, I think 39,000 were complaints. Like mostly, maybe it's not that much, but a very large percentage is that they're not looking at everything, but that's how they do most of their investigation work. So just make sure you keep your employees happy. Is my point.
That's a nice tip. That's a good
keep them happy. They'll be fine.
Yeah. So let me just reiterate. So deadline. Repeat, okay, December 31st, 2025. You can start implementing the changes, but finalizing the document, that is a deadline, so don't miss it, okay? Otherwise, it might be put on.
Yes, 100%.
Okay, so, all right, so I think that's great. Do you have anything else to add?
No, look, I just want to say thank you again for the time. I really appreciate it. If anybody has questions, please let us know. You can go to our website at easytpa.com, letter E, letter Z, TPA, just those 5
Easy,
letters.com.
very easy. Easy TPA.
Yep, that's it. The 800 number's on there, and you can hit option 1 if you'd like to talk to me.
All right,
And
thank
that's
you.
it.
Thank you for joining our today's episode of Secure Act 2.0. And don't forget to follow us on our social media platforms. And if you have any questions, comments, or topic suggestions, feel free to reach out to us. We love hearing from our listeners. Our next episode is going to be on BOI, Beneficial Ownership Information Reporting. It's a required reporting for small businesses, and penalty can be high, like as high as $591 per day. So until next time, stay inspired. Keep listening. Thank you very much.
Thank you, Bonnie. Bye.
Okay, thank you. Bye-bye.